Welcome to the Money and Wealth Show. Brought to you this week by AmericanManganeseInc.com. Here's Victor Adair.
My guest today is Danielle Park from Venable Park Investment Counsel. We'll be right back with Danielle after this.
You're watching the Money and Wealth Show.
American Manganese Inc. has a manganese deposit in Arizona. Indicated 6.7 billion pounds. Inferred 8.9 billion pounds. Potentially the lowest cost producer of electrolytic manganese. American Manganese Inc. has a projected cash cost of 44 cents a pound. The metal trades near $2 a pound. Do the math. Trading symbol AMY. Visit AmericanManganeseInc.com or phone me, Larry Ray, at 604-531-9639. Molycorp Gold Corp has substantial assets. Magnesium deposit, inferred 52 billion pounds. Molybdenum deposit, indicated 1.9 million tons. Inferred 1.8 million tons at 0.087% MO. Past silver producer, average 182 ounces per ton. Trading symbol MOR. Website molycorp.com or phone me, Larry Ray, at 604-531-9639.
Always consult your investment professional before making any investment decision. The Money and Wealth Show is archived online at talkdigitalnetwork.com. Here's Victor Adair.
Well, we're here today with Danielle Park, and by here I mean we're here in Vancouver. Danielle and I have both been speaking today at the Money Talks conference in Vancouver. It's late November 2011. I listened to your speech with great interest. I saw you had the audience was like frozen in their seats with attention. For the folks that are watching here, I mean, recap, you know, the 25 words or less. What did you have to say
basically,
today?
Michael Campbell asked us both to speak today on what we do with our own money, and what it, not so much as professional managers, but more as individuals, you know, human beings caught up in all the dynamics of money and markets, and to give people some tips on what we think is really important on that. So that's what we were both covering, basically, right?
And I think I said that Danielle and I were both singing, pardon me, from the same song sheet. In other words, we have similar views as to what is unfolding in the world. I mean, I described a situation where I break my world into my savings and my trading account. And with my savings account, they're very liquid, very conservative, and very safe. And I don't care if I'm maybe missing an opportunity here or there or giving up a little yield to be so safe with that money, because I'm making more than enough in my trading accounts to pay my expenses as I go along. I think there's going to be great opportunities here and there in the future, but right now I believe that there's more risk out there in the market, you know, under the surface than we're aware of.
Oh, I think, honestly, you know, this job just keeps getting worse. I mean, I entered the business in the mid-90s, right, going into the tech bubble. Then you get the 12-year secular bear, which we're still in. And now we have a sovereign debt crisis, which, by the way, Victor, as you know, you can set your watch pretty much 3 years after a banking crisis, right? You get the sovereign debt crisis, and here we are. And I honestly think the measurements that we take, which tend to be technical as well as fundamental macro stuff, I thought the risk in '08 was off the charts. I think the risk today is possibly even greater, which is amazing to me. But on the other hand, you know, I do think that this could be the final big downturn in this secular bear. Cyclically, this is probably the third recession coming that we've had since 2000. And if this time the governments aren't able to repump the thing, which I think there's going to be a problem trying to do, you know, even if there's more QE, you've got so much government debt today, with most of the developed world over 400% total debt to GDP, Victor. I mean, where is the money going to come from to reinflate this quickly like they did in '08? So I think that this time could be the final downturn. And if people are just cautious here and patient enough for for this thing to play out, that we might get a re-entry point here in the next year or so, which could be quite meaningful. It could be, something that you're able to then buy these dividend-paying stocks that everybody talks about, which today on all our metrics are extremely still overvalued and vulnerable to the downside. I don't want to be holding stocks right now for 3% dividend when I'm going to possibly lose a chunk of my capital. But, if things correct significantly again, we could get an entry point that gives you a meaningful buying point for a few years from there.
On the dividends, I've said on Money Talks Radio that if you're holding a stock and it's paying a dividend, 3, 4, 5%, that might numb you to the macro market risk that you're subject to. Now, it may also be, and neither you nor I pretends that we can tell the future. You just kind of look at what's going on and say, there's so much unknown out there, so much uncertainty. It seems to me to be a time that you should be cautious. If people are working, and what do you use it? Don't whip your money like a sled dog. I thought I heard you say, or in other words, you've got some savings, but maybe you haven't saved enough. Mm-hmm. Okay, so you're trying to squeeze those savings to generate the income you need to finance your lifestyle. What was your solution to that? Instead of doing that, what did you say people ought to do?
2 things: work longer. Cut your expenses. I mean, it's very simple. This whole, I've been saying for a few years, this Freedom 55 was a marketing farce. Yeah. People today don't have $10 million in the bank, Victor. As a rule, if they're lucky, they have $1 million, right? Most people have much less than that. And so to assume that you can retire on that kind of money with interest rates at 100-year lows is a problem to begin with. It's incorrect. And, the marketing machine of the industry keeps telling people, all you have to do to manage risk is diversify into a basket of dividend-producing stocks, which is not going to serve well. It didn't serve well in '08, and I don't believe it'll serve well right now. We're probably, as I say, going into a recession. That's just sort of typical in a secular bear, but cyclically we're about due. And stocks tend to lose 30 to 45% of their value in that. We came off about 20 into the end of September in most major indices. So I think we're getting towards it, but we probably have quite a bit further to go here. And you want to get some more stability and sense of where values really lie. Because right now the banking sector is full of all these, bombs waiting to go off. And every weekend you wake up Monday morning to a new sort of theme on this same delevering disaster. So to have your capital blindly plopped anywhere right now, I just think it doesn't make any sense. And like I said, historically you're not rewarded for dumb risk, right? You're rewarded for buying things at a good price when typically everyone else is selling them to raise cash. Mm-hmm. That's when your entry points come that are meaningful. That's when you're psychologically strong. That's when you have liquidity and cash to put to work. Those are the things that serve you well over the remainder of the market cycle.
Today I made the point that way more money has been borrowed than will ever be repaid. Now, there was a ripple of laughter through the room because these folks have heard me say this so many times over the past couple of years. But I really believe that. And I kind of take the Gary Schilling thesis that we are actually in an age of deleveraging. Now, there is a segment of the market that wants to believe that all the money printing is going to lead to hyperinflation, therefore gold and silver are the place to be. That may be, but I say give some weight to the thought that we have massive deleveraging from 30 years of over borrowing, and that's a pressure on the market. I see the authorities, the central banks and the governments with fiscal and monetary policy trying to hold things up while this dead weight of deleveraging is pressing down. At best, actually, I think the authorities are fighting a rearguard action, and that this deflation is going to be the thing that's going to be most uncomfortable, and some people are going to be hurt in an environment where you have falling asset prices. That's kind of my take on it. So given that that's my take, I'm very comfortable to sit in a very highly cash position, a lot of liquidity, and just watch. I'm not earning much in the way of yield. I don't care. I've still got my money, and I suppose that Michael invited us there to talk about what we're doing with our own money. I thought about that, and I thought, what I'm really trying to do is maintain my financial independence. In other words, I want to be able to hang on to the money I saved.
Absolutely, because easy come, easy go, right? People that get, as you said, like a big lump sum, that's great, but typically holding on to the lump sum is almost as hard as it was to get. I mean, you have to know how to manage the risk around it. And if you're just, I think the thing that offends me so much is that even people that are trying to do the right thing, I mean, you get a lot of reckless people that are treating markets as casinos, doubling down, hoping for the best, using margin. And, one in, I don't know, the numbers would be like 1 in 100,000 might actually get money out of that lasts any period of time. But the rest of the population is actually trying to do the right thing. They're listening to their financial advisors and they're saying, what should we do? And the typical financial advisor response is about modern portfolio theory. Just add a bit of this, add a bit of that, shiny, colorful things and pages of, stuff, which at the end of the day, in this environment we're describing, in a delevering cycle, in a cyclical bear market, with a secular bear market, with valuations overstretched, none of that is likely to serve them. Actually, it's likely to be a source of further angst, loss, pain, frustration. And these are people that can't just, sell another business or, sell another asset, house. They've already done that. So as you're saying, I liken it to being in winter. You're in winter, deal with it. You put on your snow tires, you get your boots, you walk slowly when you get out of your car, you don't drive fast on black ice. Winter will pass, right? Summer, spring will come again. But right now, you're trying to just get through the winter intact.
May gather from our tone here that Danielle and I are both a little bit cynical about the investment industry. Now, I think it's an old saw that Wall Street is in the business of selling things to people. And I notice in the papers these days, when I look at the Globe and Mail, that the big ads in there now are for dividend funds. They've figured out that that's what people want to buy. I thought in the conference that we had today, if I asked for a show of hands, who is here to get the names of 10 stocks that are going to double over the next year? Or who is here to figure out how you can get a guaranteed 8% yield? Well, you know how the hands are going to go up, because that's the mood that people are in. So the marketing arm of Wall Street, if we call it that, has sensed that. So they're trying to guide people in that direction for their own benefit. Now, that's maybe how Wall Street has always worked, and so be it. But what I think you and I were trying to do when we stood in front of the room and talked about what we're doing with our money is saying, given the exposure we've had and so on, this is what we are doing. So before we wrap it up here today, what are you doing with your own money?
Well, right now, I have nothing on the long side of the equity market.
Okay.
I have high quality bonds, but I haven't been able to buy any in several months. The last time we got a sell-off in the bond market was last December. We were able to buy some high quality stuff below par for about a month and a half. Did that. That's all done well.
And high quality, is that other than governments?
Government of Canada and high Canadian corporate bonds that were trading below par. Some high dividend yielding stuff that we bought actually in 2008, in November of 2008, which has been yielding great throughout, has gone up a lot, so far so good on that side. Eventually I think bonds will have to be reallocated as well or downsized, but right now I don't see that as the immediate term concern. The recession in Europe, the recession in various parts of the world, I think is going to keep rates low for a considerable period here, at least on the policy end. Now, you see them spiking. The real risk seems to be in the sovereigns right now, but not so much in the Canadian bond market, if you follow what I'm saying.
Sure.
And then I got the U.S. dollar T-bills, which I know you have as well, and that's been going up in this turmoil. I say people shouldn't forget the short side of the market. I say that because you can make some money on some of the volatility-like products, but my experience is very few people are cut out for it. In other words, those things can move 10%, 20% up or down in a day, right? So it's one thing to say you can use those as like spice on the sauce a little bit, but you have to be really emotionally prepared. And I find most individual investors simply aren't. So it's a question of really just trying to make a little bit of safe gains where you can, and being patient to let this train sort of run its course.
When I look at your website, your blog site, maybe that's the modern term, jugglingdynamite.com. I get the sense, and I look at that probably a couple of times a week, and I've been doing that for at least a year now, looking at that. And after I read your book, I get the sense that you are trying to just make it through this period of time, be safe, hang on to your dough, with the expectation that there will be an opportunity in the future to make some more traditional kinds of investments. Am I getting you right?
Basically, I mean, you know, I say this every day. I wish I could just go buy preferred shares, high quality preferred shares. Do you know what? They don't really exist right now, at least not below par. The reason is banks made all these fancy types of preferred shares in the last few years that were all serving their own purpose. You know, indefinite terms to maturity, not necessarily cumulative, can be called at any time. And people have been so desperate for yield, they've been gobbling those things up. So now their $25 preferred shares are trading for $27, $28. And they're not favorable terms. So you can't just go get preferred shares. You have to look at what kind, what issuer, what terms, right? Then you look at common shares. You say, I wish we could just buy high yielding dividend paying stocks, except that they're all trading for more than they should thanks to liquidity over the last few years. So it's not, you can certainly make your buy list. You can certainly say, you know, when I'm fully invested, I would like to have X percent in this, X percent in that. But, you know, it's like if you go out on the marketplace to buy anything, if you can only find things that are twice as much as you think they're worth, you know, you should just wait till you find something that's the right price. And, you know, Benjamin Graham said it's a question of character, more of intellect. And I think this is the test of character right here. What you do, how much can you wait for the right price, and how much do you run with the madness of crowds? And that's what defines your success eventually.
I think we ought to just play that again. I mean, that was perfect. You know, one of the notes I have on my trading screen is, it's okay to do nothing. And that's there. I mean, I've got a number of little sticky notes on my trading screen. Maybe again, before we wrap up, probably the key thing I had to say to the folks in the room today was that over the last year or so, I've converted over 20% of my net worth from Canadian dollars into US dollars. Now that is a little bit of a call, because I'm thinking that the US dollar is going to do better over the next couple of years. But it was almost like I woke up one day and I thought, hey, wait a second, I've got all of my assets in one thing, in the Canadian dollar, and I should change that. You know, I should do something about that. So I've moved some money into the United States. If I was going to buy something outside of Canada, I'd probably go to the States. And realistically, given that the Canadian dollar was in the 60-cent area here about 8 years ago, and now it's been above par, I've made out like a bandit. And I just honestly was in the right place at the right time. It's not like I made a decision that Canada was the place to be. I just was here. So to take some of that money off the table just seemed prudent to me, in addition to being very cautious with my savings.
Yeah, well, we use it as a asset class. The US dollar for Canadian investors is actually one of the fifth asset types, and we're pretty strategic. We bought it in 2008, sold it in 2009. We bought it again at the beginning of the end part of 2010. And are holding it today. So it's just one of the things that we put through our technical filters. So it's not so much just what you're describing in a, hey, let's have some more, you know, diversity in terms of the international currency. For us, it's just been one of those places that you can make some decent gains. I mean, 22% in 08, Victor, right? Just US T-bills. I mean, who needs a lot of risk to make money? That's the first thing. The second thing is that the business is always telling people don't hold cash for their own purpose, because most of them are structured in such a way that they can't make any money or any fee or any commission if they let people sit in cash. So there's this just systemic bias about saying you must always be in stuff. Don't worry, you can go from this bull market to this bull market to this bull market. It's BS. You know it. It is. It's not true, and it doesn't serve people.
Danielle, thanks for taking the time to be with us today. I really appreciate that, sharing your views. And you want to stay up to date with what Danielle has to say, jugglingdynamite.com is her blog site. Thanks, Danielle.
Victor, thanks.
The Money and Wealth Show has been brought to you by AmericanManganeseInc.com.